Hi there, I'm Mark Sebastian. Welcome to Option Pit Driver's Ed. Before I begin, please read this disclosure. I am here to educate you. I'm here to teach you. What I'm going through does not constitute investment, legal, or tax advice. So welcome to Driver's Ed. And today we're going to discuss what is a call. What is a call? A call option is an option contract that grants the holder the right, but not the obligation to purchase the security at a predetermined price. That means the holder of the call has the option to purchase the stock, they're not required. The buyer purchases the right to buy the stock for a price in the open market. This is the value of that contract. When the call is exercised, the holder buys the stock from the person who sold them that call. So the person who sold the call collects the premium, the purchasing price, but they have to deliver the stock to the call holder. The call holder is doing something called exercising the call. I will get into exercise and assignment at a later date. So why would I buy a call? By owning the option contract, the call contract, the owner has a fixed cost on the stock. That fixed cost is the stock strike price plus the cost of the call. If the stock does not go above the strike price, the owner does not have to exercise the call. Thus, the cost to the holder is only the cost of the call contract. So it has a limited downside. That's why people like to buy calls. So a customer buys a call contract on stock XYZ for $2 at the $50 strike price. The break-even point for the holder of that call is if XYZ reaches $52 at expiration. And it's pretty simple, right? $50 strike price plus the $2 cost of the call equals 52. That is where our break even is. So to break it down, the holder of the call, the XYZ $50 call, has two options, right? Stock above $50, even if it's not to 52, the holder of the call is likely to exercise because there is still value above that $50 strike price. Below $50, the holder of the call does not exercise. And FYI, if you are long a call at expiration, expirations are every week on Friday, or if it's a less liquid contract, it will be the third Friday of the month. All right. If the stock is just a penny above the strike price, the holder of that call is automatically exercised unless they tell their broker differently. So if you own a $50 call in XYZ, and XYZ is trading $50.01, that call will be automatically exercised for you unless you tell your broker not to do so. Likewise, the other way, if the stock is $49.99, the call will not be exercised. If the stock is trading exactly 50, it will not be exercised automatically. You would need to call your broker and say, I want to exercise this call. So who uses calls? Large institutions use calls as a replacement for stock. They will buy calls instead of buying a stock. Or sometimes they will sell a long stock positions, which means they were holding the stock. They will sell a long stock position and then buy a call. This is typically done when they believe the stock is near a top. And finally, some institutions will buy calls to hedge a short position. So the lesson here is when you see a huge call purchase, it's not always what you think it is. The call is used by large institutions primarily for insurance, right? If I'm short a stock and it goes above my call price, I'm protected. Or if I'm long a stock and I sell it and then I buy a call, well, I have locked in a profit on my long stock position, and then my insurance value is that I use the call so that I don't miss out if the stock does keep going. All right, now retail traders, on the other hand, tend to use it as a pure play on direction. The call is used for speculation. It's used for betting that the stock will go higher. Now let's talk call pricing. As the stock rallies, calls will generally increase in value. As the stock falls, calls will generally decrease in value. In my business, the option business, this is called having positive delta. Delta is just a fancy word for correlation, how it moves with the stock. So calls are positively correlated to a stock price. This is a chart of a call. Now I want you to pay attention to the green line. The green line is what a call will do at expiration. And what I want you to notice, in this case, the strike price is 40, not 50. If the stock moves above 40, the call gains value. Below 40, where I've circled, what I want you to notice is, look, that profit and loss stops. You can't lose any more than the call purchase price. The break even, which is right here, is the strike price, which is $40, plus my call purchase price. In this case, the call was $1.40. Thus, my break even at expiration is $41.40. Let's talk a little more about call pricing. If a stock is trading above a call strike price, it is called in the money. The call is in the money. In the money calls will move more closely with the stock price. The more in the money, the more it will move with the stock. If a stock is trading at a call strike price, that is called at the money. The stock will still move pretty severely with the stock, but not as much as if the call was in the money. If a stock is trading below a call strike price, it is called out of the money. The calls are out of the money. They will tend to move the least with the stock price. Other factors that affect the call price. So the number one driver on the profit and loss of a call position, a long position, if you own a call, is movement in the stock. The more in the money or closer to in the money, the more the option will move with the stock's price. But there are other factors that affect calls that we will get into in the future. Perceived risk being the second most important. That's called implied volatility. Passage of time also affects a call's price. The longer I hold a call, it will lose money. Insurance decays. Over time, insurance becomes less valuable, and the call will lose money. And then finally, dividends and interest rates will have differing effects on a call's price. So there you have it. That is the basics on what is a call. Next week, I will talk about what is a put. Thank you. I'm Mark Sebastian. If you have questions for us, please email me, mark@optionpick.com, or call us 888-TRADE-01, 888-872-3301, and we will be happy to talk to you. Have a great day, a great week, and I'll see you next time.